This is ShadowQuant, Week Ahead, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Saturday, July 18, 2026, and this is the New York session. Now, let's get into it. Welcome to ShadowQuant's Week Ahead. Google and Tesla are the twin heads of this week's snake, reporting after the close on Wednesday, and with the Nasdaq down more than 4% last week, the street is bracing for a potential liquidity event in the very names that have driven the entire bull market. I am your host, ShadowQuant, and here is your cross-market outlook for the week of July 20th. Let's look at the track record. Pulse, you're on a 5-call winning streak, sitting at 70% accuracy. Grid, you're on a 6-call losing streak, sitting at 52%. SPECTER, you're on a 2-call losing streak at 56%. And Apex, you're on a 4-call losing streak at 44%. Any reflections on the recent misses?
My misses have been technical. I was too quick to call a bounce in the Russell 2000 last week when the data showed the small caps were actually holding up better than the growth stocks. I let the sector rotation bias override the index structure. I'm recalibrating to trust the price action over the narrative.
I've been too focused on the dollar index strength and missed the subtle shifts in commodity positioning. The COT data showed leveraged funds adding to shorts in the Canadian dollar, which gave me a false sense of security on the dollar-CAD spread. I need to look at the specific contract changes, not just the net position, next time.
My syntheses have been too static. I've been linking macro to equities in a linear way, but last week showed a decoupling where safe havens rallied while equities fell. I need to allow for that divergence in my cross-market model.
I've been right because the macro data is screaming inflation stickiness. The CPI print was hot, the payrolls were solid, and the market is finally pricing in that reality. It's not a guess, it's a direct read of the Fed data. Let's get into the macro landscape. Pulse, walk us through the economic calendar and the current rate environment. It is Saturday, July 18th, 2026. The market is quiet this weekend, but the setup for Monday is defined by what happened last week and the massive earnings reports coming Wednesday. That sticky inflation backdrop sets a high bar for the tech giants. Grid, equities, earnings, and indices.
The equity picture is mixed, with the S&P 500 tracked by SPY, closing at $743.29 last Friday, down 1.54% for the week. But the real story is in the Nasdaq 100, tracked by QQQ, which crashed 4.16% to close at $695.33. The Dow Diamonds was at $520.81, down only 1.0%, and the Russell 2000 IWM was at $294.04, down less than 1%.
The technical damage in tech is severe, but let's see if the dollar is helping or hurting. SPECTER, currencies and commodities.
The dollar index is holding firm, and that's putting pressure on emerging markets and commodities. Let's look at the major pairs.
A crowded short in the yen and a rally in gold. CIPHER, digital assets.
Crypto is watching equities closely, but it's also reacting to its own internal dynamics. Bitcoin is trading in a tight range, currently hovering around the key support levels established last week. The broader crypto market sentiment, as measured by the Fear and Greed Index, is in the fear zone. This is a contrarian indicator. When fear is high, selling pressure often exhausts, but it's not a buy signal until we see volume return.
So we have sticky inflation, a tech sector under pressure, crowded forex shorts, and crypto watching the megacaps. Apex, let's bring it all together. Cross-market themes.
Let's synthesize. There are two dominant themes emerging from this data set.
Yes, the CPI is at 3.46%, and GDP is only 2.09%. That is the textbook definition of stagnating growth with persistent inflation. The flat yield curve is the market's way of saying we don't know if the Fed can control this. It's a high-risk environment.
Perfectly. Gold is a hedge against currency debasement and stagflation. While the dollar is strong, gold is ignoring it. That tells me that institutional money is moving into hard assets because they don't trust the fiat system to manage the inflation spike. It's a bearish signal for the dollar's long-term credibility, even if it's strong today.
The rotation into energy and staples is the direct result of that stagflation fear. Investors are abandoning growth stocks because their future cash flows are being discounted at a higher rate due to the sticky inflation. The drop in the technology sector, down 5.48%, is the market repricing the entire AI narrative in light of macro reality. If Google reports weak cloud growth, it confirms that the macro headwinds are real, and it will accelerate this rotation.
Crypto is in a holding pattern. It's too correlated to the risk-on assets, tech, to lead a rally, but too independent of the traditional financial system to crash with them. The fear reading on the Fear and Greed Index suggests we're near a local bottom in sentiment, but until the macro clarity arrives from Wednesday's earnings, crypto will likely chop sideways. The stablecoin inflows are the only bright spot, suggesting smart money is accumulating quietly while the retail crowd is distracted by the equity drama.
So the single most important thing to watch this week is Wednesday's aftermarket close for Google and Tesla. If they show resilience, we could see a short squeeze in the euro and yen. If they falter, we could see a broad risk-off event that pushes gold higher and tech lower. The data points to a fragile equilibrium that breaks on either side.
Calls on the record, one each, grid equities.
The Nasdaq is in a clear downtrend with QQQ breaking below key support. The sector rotation into defensives is confirmed. I expect the selling pressure to continue as investors digest weak earnings guidance. My call, SPY bearish, target $735 by Friday close.
SPECTER, FX and risk.
The leveraged funds are heavily short the euro. With the U.S. economy outperforming Europe and sticky U.S. inflation, the dollar should remain strong. I expect the euro-dollar to test the lower end of its weekly range. My call, euro-dollar bearish, target 1.1390 by Friday close.
CIPHER crypto.
Bitcoin is consolidating in a low volatility range, supported by on-chain stability but weighed down by macro fear. I expect it to hold its current level as it waits for clarity from the equity market. My call, Bitcoin neutral, target $63,500 by Friday close.
Pulse macro. The 10-year yield is reflecting the sticky inflation data. With the Fed in a wait-and-see mode and no meetings this week, yields will drift higher as the market prices in the lagged effect of restrictive policy. My call, 10-year Treasury yield bullish, target 4.62% by Friday close. Apex cross-market synthesis.
The cross-market theme is defensive positioning. Equities are rotating to value, gold is rallying on stagflation fears, and the dollar is holding firm. I expect the S&P 500 to test lower support as the week progresses. My call, SPY bearish, target $738 by Friday close.
If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. That wraps up this edition of ShadowQuant. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.